10 session planned for you. This week, we revisit California Prop 19. If you attend our session in December, this will be a good review, and you will learn about the updates from the Board of Equalization. If you are new, we'll start from the basics so that you are caught up. Welcome to Tuesday Afternoon Networking. My name is Coco Tan. I'm a realtor with Keller Realty in the San Francisco Bay Area. This is a busy time of the year for me because it is such a hot market for sellers. I get new listings all the time, and many of them stay on the market for less than 1 week. The only way to know about all of them is to connect with me on WeChat and subscribe to my YouTube channel. Here's a QR code from my WeChat, and this is my YouTube channel. I appreciate all of you that have already connected and subscribed. Let's go right to it. As you may remember, California Prop 19 is an amendment bill recently passed during the election this past November. It is a very complicated law regarding the property tax basis that affects people who are over 55 years or older who want to move, as well as the property taxes for children who inherit properties from their parents. It comes with advantages for some and disadvantages for others. But I know you're not here to listen to me go into the details of this law. So I did ask all of us a favor by inviting back Michael Lee of RE Attorneys. You may remember Mr. Michael Lee from our previous asset protection seminar, Shields Up in January, as well as the first Prop 19 discussion last December. He's a managing partner at RE Attorneys, specializing in wealth management and estate planning for high net worth clients. Michael is also a professor at Santa Clara University Law School, but he has taken part of this evening off from teaching his class to join us here. Hello, Michael. How are you today?
Fantastic, Coco. How are you?
Thank you. I'm so happy to have you here again, since everybody loves your presentations.
Well,
can you give us a review of this proposition and then tell us what it means now that we passed February 16th already and approaching April 1st?
Yes, well, I'm thrilled to be with you all again because now I have actually better and more accurate information to give all of you, which is great. The only disappointment is I am not in my lovely office. I had to take care of my kids earlier this morning, so I'm broadcasting live from the children's playroom because it was very convenient.
Thank you so much. Really appreciate your precious time.
Oh, no, it's my absolute pleasure. So basically, I'd like to kind of start off with where we are. As we are now after February 16th. And February 16th was a major date for this Proposition 19, this law that was passed for California. And this is kind of an interesting thing that we'll talk about a couple of times in our 40 minutes here together. Is that Proposition 19 became law in kind of an unusual way and a special California way. And in California, sometimes we do things our own California way. And one of the things that we do in our own California way is some laws are passed by our legislature, by the Capitol in Sacramento, and some are actually passed in a completely different way, and they are passed by the voters. And basically a group of people come together and they say, I have a good idea, that should be the law. And they say, okay, if you can get a whole bunch of signatures, if you get so many signatures, we can put it on the ballot. And if everybody likes it and you get past 51% or 50% plus one vote, it becomes the law. And that's what happened with Proposition 19. So last year, we talked about Proposition 19, so the good, the bad, and the different. And it has some good things. Some of the good things, which we'll see in a moment, is for older persons, older Californians over 55, those disabled or those suffering from wildfire. It has some great things where you can take your base year assessment, if you meet one of those categories, and take this with you if you purchase a home that's sort of equal or lesser value. You can keep your assessed value. We'll see if you purchase a property over your base value, your sales base value, how it increases somewhat. So that's overall, we're going to take a look and see that that's pretty good. And then we're going to turn and take a look towards the end of our chat tonight of the kind of the bad, the part where we say, oh, but the parent-child exclusion, we've changed quite a bit. So we'll take a look at those two things. The thing that makes me very happy as a lawyer is, the irony is we now have some rules. One of the key problems that we had last year when we were talking about this is I got some great questions from our lovely group here as people had these interesting ideas of like, well, what if I do this? What if I keep the property, I transfer and I do this? Or what if, I have some of these very practical questions I had as they said, well, wait, what if I have 2 or 3 brothers and sisters? Does the second part of Prop 19 mean we all have to live in the same house? That's not going to work. What happened finally, in the early part of this year is the Board of Equalization finally started to issue some proposed rulings, some proposed law to give us some guidance on what to do. Because needless to say, the law for Proposition 19 was relatively vague in many, many areas. Why? Because again, this wasn't passed by the people who normally write the law. This was passed by other people. And it's kind of a funny thing is what we'll say at the very end of the lectures, people always ask about the federal law changes, federal estate tax, federal income tax, what's changing? Well, I can tell you the Biden administration has generally put it out that they say they are going to change the estate tax exemptions. They are going to change some of the income tax brackets. But then when asked, they said, well, is that going to be in 2021 or is that going to be over in 2022? They said, oh, it's definitely going to be in 2022. We need to do this very carefully and be very careful with the law so that everybody knows how to react and how to apply it. So it's the exact opposite of what we had with Prop 19, where it passed and we were given a date and there was really no time to react, even for the Board of Equalization, the government, even for them to get prepared. So let's get right into it of what we're talking about. And what I like to do as a lawyer is that I have slides prepared, of course, and I'll show them periodically. But the first thing that I'd like to actually show everybody and what I'll be working through is actually the actual BOE documents themselves. I'll show you, and we'll circulate this, and Coco, you can help me kind of circulate this to the group, is the BOE now has a website for this that everybody can also take a look, and everybody's welcome to contact me too, but we now have some guidance. So let's take a look. So what are we going to take a look at here is the BOE has prepared this sort of basic summary for us to compare what was the law and what is the law now. So what we're talking about is the first part of the Prop 19. So let's take a look over here. So with this, we've got over on this side here, is that, talking about Proposition 19, of course, this is us. There's the first part. And this is for those over 55, severely disabled, fire victims to transfer their base year value. The old system, as we'll see, taking a look at the way the BOE outlined it for us, is that what this is for, think of some rules. First rule is transfer of the base year value has to be your primary residence. That's the first thing. So it only works for our primary residence. If I have a primary residence and say I'm going to sell the rental or I'm going to do something with the rental, it's not going to work. It has to be the primary residence. In addition, once I sell the first property or I dispose of it through some transfer, we'll see about that, I then have to acquire or purchase the new residence within 2 years of that sale or transfer. But the good thing, this is the key part, my new property can be anywhere in California, can be anywhere. So if they have a property here, they can move out to the east. They have something in the east, they can move over here, north, south, wherever. Many of you may recall this wasn't the law before. As you see, county with the intra-county ordinance, only 10 counties. We have 54 counties, 58 counties in California. A lot of counties weren't included in that, only 10. So now all of them are included. So Because of that, we now can move everywhere. In fact, even my parents are doing that now because it's a, as Coco said, it's a good time to sell. And it's a good time if you're an older Californian to take that with you if you're downsizing, which always used to be a problem. So continuing on with our rules for this transfer of the base year value, it can be any value. I received some questions where sometimes people mix up the Prop 19 first part and second part rules. The first part, the value doesn't really matter in the sense that what really matters is the, see it here, the base year value, basically the value at the time that you sell or transfer that first property. That value matters. And the value of the property that you're acquiring matters. And we'll see how the calculation works in a moment. So if I sell at 500 and I purchase the new property at, let's say, we say I sell the first one at 500. My original assessment was 300. My new property is 475. Under the new Prop 19, I keep my original assessment of 300. So because the fair market value at the time, the base value was the 500 value, that would be the one that I would get to use to be the mark for anything that I purchased that's below that value. I keep the basis. If it's above, as we can see, the amount above 100% is added to the transfer of value. We'll just hold this because I'll show you the exact numbers in a moment. So we can do that. The mix-up sometimes happens back to this value limit is some people mix up that second part, that $1 million for the parent-child. That $1 million is for the second part of Prop 19, the parent-child exclusion, not for the first part, for the base value. The other thing for this, for persons over 55, and I'm generally going to say the words over 55 rather than the string of people, because it's just easier shorthand. So generally, how many transfers can you do? You can do this 3 times. So grandma and grandpa or mom and dad, they can move once, downsize. They, this is very common. I have this happen, fairly frequently. They can, they're in coastal California or they're in the Bay Area. They move out to the east. They realize, oh, they don't like the east, and then they want to come back. That happens fairly frequently. Or they move out. They move closer to one child. That works for a while, and then that child moves. They have to get transferred, and then they want to move closer to another child. So the implementing statute, as you can see, the BOE, this is so new. The actual law statute that goes into the law book, we don't even have the number yet. This is so new that they're putting it in, but it's the law and it's coming. And this one is effective, of course, April 1st, 2021. And why is does this date matter? It matters in this sense. And of course, because we're March 31st, really not a big problem. But basically, your sale and purchase has to either be both of them after April 1st, or at least one of them on the other side. So if you sold earlier this year and you think, oh, nuts, I sold earlier this year, you're okay. If you sell on that side of the year, okay. But if you purchase after within the 2 years, you'll be okay. So this is a good sort of shorthand of what we're trying to do with the base value transfer. But even this is a little bit vague for us. I think even this isn't so good. So the BOE, surprisingly enough, has done us a little favor. And what they have on their website, right here with Proposition 19 here, is they have guidance that's issued. And they issue these things called letters to assessors. And again, I show this to you because the more knowledge that you have, the more information you have, the more things you can start to understand. And of course, whenever you have a technical question, you come talk to me, but I can walk you through the process of what we look at. So these letters to the assessor come from the Board of Equalization, and they say, this law is confusing. We're the Board of Equalization. We decide what it means. We got together and we are giving you these letters, county assessors, to explain what we think the law means. These are very useful for how to know how to conform your behavior, how to do your transactions, because it's basically the BOE telling everybody, and telling not just everybody, telling the county assessors who are going to be the ones assessing the tax to say, this is what we think the law means. This is the letter from the boss that says, this is what I think you're supposed to do. And the assessor says, okay, generally they follow it. So here's the key thing that I just wanted to break down for this rule that looks like that we're going to have. So as we see highlighted, and we'll zoom in a bit, is this base year value transfer is any person who's over 55, disabled, victim of the natural disaster, can transfer the factored base year value of their primary residence to a replacement primary residence, regardless of location or value. So again, the county thing doesn't matter. But there's always one of these things. If all of the following conditions are met. So that's a trap always when you see that in the law. All of the following conditions means there's a lot of rules that we're going to get. And here are some of the rules. So first rule, the person sells the original primary residence within 2 years of the purchase or new construction of the primary residence. So either the sale of the primary residence purchase, but not both, can occur before April 1st. So as you can see, like I mentioned before, if one portion happened before April 1st, that's okay. You just can't have both portions occur before April 1st. So as you can see, you can have the sale of the primary residence within the two years. That gives some flexibility for timing. So we have a 2-year rule there. And as you can see, just the way this is normally designed, we have A, that's our first general rule. And then we have to tick off all of these things, 1, 2, 3, 4, 5, 6, which we'll see. So the first one we have to see this is sells the original primary residence within 2 years of the purchase. So it can be before as well, but it has to be within 2 years. The second part is the real property is the person's original primary residence, either at the time of sale or at the time of the disaster. So we have this 2-year rule. It has to be the primary residence. And here's another key thing. The original primary residence undergoes a change in ownership that subjects it to generally full appraisal. So, and they give an example. So this is a question that I received many times last year in late December, is people said, well, what if can I have my primary residence and then keep the old one and move to the new one and take the old, the old assessment and bring it to the new one and somehow hang on to the old primary residence? Looking at this rule, that's not easy to do because you have to meet all of these conditions. And one of the things is you have to cause that first primary residence to be reassessed, to cause a change of ownership for it to be reassessed. The easiest way to cause the change of ownership is you sell it. That's the classic one. The other way that it can be done is one transfers it in a way where it causes the change, the complete change of ownership. If I transfer it to my brother and then brother sibling transfers cause changes of ownership, that would cause a change of ownership. I might be able to keep this. But the way the statute is written, generally the classic way is through sale. They give an example, a caution example here for this change of ownership, is they show brother and sister are co-owners of a primary residence. The sister sells half to the brother and then purchases a new primary residence. They say she's not eligible to transfer her base year because the original primary residence did not get a 100% change in ownership. It would have only gotten a 50% change in ownership. So here's a tricky thing if you're trying to structure this transaction, is you have to trigger reassessment of the first property. If you don't trigger reassessment of the first property, it's not going to work. So continuing on, we've got 3 down. What else do we have? 4, the replacement primary residence is purchased or newly constructed within 2 years of the sale of the primary residence. Here's this 2-year rule again. So we have 2 years here. We have this portion that gives another example about selling the primary residence and then following the 2-year rule. So that's section here. So we're seeing that we have a number of rules in this, and I'll show you in a moment how we do the calculation. So that's rule number 4. What about rule number 5? We also have the person seeking the transfer of the factored base year has to file a claim. So we're seeing, look at our rules here as we go through. We have one has to be the sale or transfer within 2 years, has to be primary residence, has to cause change of ownership of the first property. The replacement residence has to be within 2 years. So we have 2 years on each side. And then we have number 5, we have to file a claim. And then after the claim is filed, it has to qualify as the person's primary residence. You actually do have to live there. And the person has not been granted this more than 2 times before. So again, two times before, you get 3 total. So there are 7 rules, 7 parts to how this works. The other key thing that I wanted to show you with this is how the calculation works, because there's been a lot of confusion on how the calculation works. And example 7 is a good example of how the calculation works. So let's say we're just going to assume I meet all of those 7 requirements. So it was my primary residence, I sold it, sold the first one, I'm going to the new one, so I'm bringing it to the new one. That's going to be my new primary residence. So I qualify and everything. I'm going to file the claim form. Everything's A-okay. How does the calculation work? So this is the prime example of this. So we say the factored base year value of owner's original primary residence is $300,000. So that's basically what their property tax bill is showing, at the time of sale. So after, when they acquired it and all of the years, the small increases, their property tax bill, the factored base year value is showing $300,000. So the owner then sells the primary residence for $550,000. So I've been paying property tax on the $300,000, but it's time to sell, and I get $550,000 for it. So that's about the fair market value, of course, is our assumption. That's what we sell it for. If I purchase a replacement property at $500,000, what is the result? Since the full cash value of the replacement property, my second property, it's the one I'm moving to, is less than the sale value of my old property, the new base year is $300,000. I get to keep it. So what's the simple shorthand rule of this? Is if the property that I acquire, the new one, the second one, is the purchase price is equal to or less than the value that I had prior to that, which is the sales price of the old property, I get to keep the original factored base year. I get to keep the $300,000. But what happens if the situation is different? So as we can see, if the new one is lower, I keep my original basis. But what happens if it's higher? If it is higher, it works like this. So we assume some of the same facts as example 7. Let's take a look at example 8. So my factored base year is $300,000. I sell for $550,000, but this time I'm buying a property that is more expensive than my original property. If I buy a property that is more expensive than my original property, let's say our example here is $600,000. Since it is greater, what you do is you take basically the difference, it says right here, the difference between the full cash value of the replacement property and the full cash value of the original property, whatever that difference is, new purchase price, old purchase price, you subtract that, you get the difference, you add that to the original base assessment. So when I originally had 300, it now goes to 350. So that's the twist of how this works, is if you purchase something of lesser value than essentially the sales price of your first property, you keep your original basis. If you purchase something higher, the difference gets added on. And this can be, again, for whatever value that you happen to have. If you purchase something substantially more valuable than your original property, that difference between the old property fair market value, which is the value of generally of the sales price, that will be where you calculate the difference from. So that is how we calculate and figure out the sort of good part of the Prop 19. The key thing is thinking about the new property. Is the value higher or lower than the old property? If it is lower, then we get to keep the old basis. If it is higher, we get to keep the old basis, but we have to add on some. So will we, the key thing is, will we be paying exactly the fair market the assessment on the fair market value of the second property? No, we'll be paying a little bit less, but it's definitely not going to be identical to the original one. It's going to be somewhat more. So that is the rules for the property taxes for the good part of Prop 19, bringing over the portion of the base assessment for persons over 55. What about the other part? There's another part of Prop 19 that happened, and this one is a little bit more challenging. So we'll take a look at this one here. It's over here. And this is the Prop 19 second part. This is the exclusion part between parents and child. So let's shift gears totally. We are no longer in the over 55 zone. We're not doing this transfer from one property to the other. We are in the situation of either gifting or through inheritance, transferring properties down to the next generation from parent to child. So this is the key change that we have here, which now is the law, which now is the situation that we have to live in, because we are after February 16th. And many of you worked with me through the craziness of January and February, doing transfers prior to that. We're now post that. So what does the law say? So under the current 19 for the parent to child transfers, this focuses now entirely on the primary residence. So the primary residence is the only place where we have a parent to child or grandparent to grandchild exclusion. That's the only place we have it. And we see that right here, this other real property. There used to be a transfer lifetime limit of $1 million of the factored base year for prior transfers, but for the new Prop 19, that is totally eliminated. What does this mean is, under the old law, for some rental properties, you could transfer the rental properties from parent to child and they would not be reassessed. Now, transfers of all rentals are going to be reassessed when they go parent to child or grandparent to grandchild. That whole section has been removed. So with the new Prop 19, we're discussing just the primary residence, the transferor, and the transferee. And there is a cap on the value. The old system, there was no value restriction. There was no value limit at all. So you could have, a house that you bought for, $500,000. Parents give it to the kids. The kids receive it at, let's say, some crazy value, $10 million. They would keep the assessment back on $500,000. Didn't matter any value. Now there is a limit. Now there is a limit of $1 million of current taxable value. This will be adjusted annually, but it will be generally around $1 million. Amounts over that will be added onto the base and increase the taxes. So everyone will get $1 million sort of gain or increase freebie, but anything over that, it's going to add back to the base. So that's for the primary residence. The grandparent grandchild, the general concept stays the same. Do remember, there's always confusion, even under the old law was like this, is transfers from grandparent to grandchild were only excluded if the parents were deceased. So if grandparents gave to grandchild and the parents said, "Oh, thank you, Mom, I really appreciate that," that would cause a reassessment, because if I'm living and I'm able to say that, then it does not qualify. So just to remember, that was true under the old law and is true under the new law. So with the new law, we have, again, primary residence, value limitation. You also have to, whoever is the recipient of the property, the child, has to file the claim for homeowner's exemption, the property tax form. They have to file that with the county assessor within 1 year of the transfer to alert them of the transfer. So that is the filing period for that. So somewhat similar to the over 55 transfers. So this is the law that we have now. There is quite a restriction on it. And I will point us over to, again, what the BOE has for us, because I find it really interesting. This one I think is kind of funny. So this is question number 1 and concern number 1 that the BOE has. And the question number 1 that the BOE has on this one is, question, isn't Proposition 19 unfair? And didn't the legislature mislead the public? The Board of Equalization and the county assessor should not enforce it. This is question number 1. And basically what the BOE says is, they say, unfortunately, we can't control the law on this. If the public passes it as a law and that becomes the law, we're stuck. The BOE can't terminate laws that get passed. So if laws that get passed we don't like, what we have to do is contact our legislative officials and say, we don't like this. Can you pass something in Sacramento to change this and fix this? But unfortunately, the BOE says, we just have to interpret the law that we've got. But I found it funny that they say, isn't this unfair? And shouldn't we just not follow it? Everybody would probably like to do that, but unfortunately, we are a little bit stuck. So with that, we are stuck with it. So with this, the operative date is February 16th. We've gone through that. I'm going to skip all of these things. There are just a couple of things that I wanted to talk about here. There were some key questions about how to do these transfers, or in your estate planning, thinking through the new Prop 19, because in your general estate planning, will, trust, all of this, you're going to have to start thinking through a lot of the planning on how to do this, because some things have changed. So one of the key things is this has to be the family home of the transferor. So again, we're thinking about rules for when you're doing estate planning or you're doing a gift. You do get the $1 million exclusion for the family home, the primary residence. If it's not a family home, it doesn't qualify. And the family home must become the family home of the transferee. So they did clarify this, which is very good in the letter to assessors question 15, is they said, okay, what if I'm doing a revocable living trust, I'm doing my estate plan, and I have 2 children, and I say, oh, I just want to leave it 50-50 to both of the kids. Is that going to cause a problem, or do I have to choose one child or the other, or do we have to do something complicated? Well, the good news is that if you are passing the family home to the 2 children, they do not have to both live there together. One can live there or the other can live there, and they can also switch. So you also can have one child be living there, that child wants to move out. And the time is set, here we can outline further. If the other child wants to move in, they can move in and you can keep the assessment. So there is a requirement, of course, for the transferor to have it as the family home, and then the transferee is as the family home. So that is the requirement there, but it doesn't require both persons to live there at the same time. So here's another problem, and this is a key problem. This is for question 17 that got clarified by the BOE. Okay, let's say I'm an only child. I inherit the family home. I go and live there for a year or 2 years, and I'm enjoying their original assessment. The property didn't have more than $1 million. Maybe it had $950. I just squeezed in and didn't have any increase, but I was close there. What if I decide to go purchase another property, and I'm going to go make that property my family home? I'm not going to continue using the old family home, my parents' home, as the original family home. I'm going to move. What happens to the assessment then? Well, something interesting happens that was not like the old law. I lose it. I lose the low assessment. If I take my homeowner's exemption and I move it to a new property and again, I'm an only child, this becomes a rental, the home fails to qualify as the family home, and then it no longer qualifies for the exclusion, and it will be reassessed. So this is very interesting. Under the old law, I could inherit my parents' property. I didn't have to live there at all. So there's no requirement to live there. And I kept the assessment permanently. So I could inherit it and immediately use it as a rental. I never lived there, no problem. Under the new law, the child has to live there. And as soon as they move, it gets reassessed, except for some special situations such as being in the military or something like that. It's going to get reassessed. The same thing for multi-unit properties. So owning an apartment complex or likely even a duplex, if one lives in one of the units and wants to transfer it, does the entire complex get reassessed, or just that unit? How does this work? The guidance from the BOE says no. The unit occupied as the family home qualifies for the exclusion, but the remainder would be reassessed. So it's a little bit unclear, and this is something that has not really gotten clarified, is for things like duplexes on the same APN. What happens when you have the two different units? That's still getting somewhat shaken out, but that rule seems to be an apportionment rule. So as you can see, they're guiding through there. Situations of the trust all still work. So again, doing a will trust to avoid probate, very, very important. So one wants to ensure to do that to avoid probate, to avoid conservatorship, to avoid any problems like that. So that is very good, and that will still preserve all of the Prop 19 benefits. So that's certainly important, and it's certainly important when doing estate planning, as you're seeing all of these rules as we went through. The number of questions, you're just scrolling down, 44 questions and answers to this thing. Very, very complicated. One of the things that one would really be well served by is thinking through your estate plan, working with your estate planning lawyers for, is my plan going to work well for Prop 19? Did the old transfer system, the way that I have it, work well? Or should we think about something more creative, or something to try to solve a problem? And this is how we kind of guide into the potential issue here. Limited liability companies. Do remember, when a property is in a limited liability company, especially a primary residence, transferring the company to the kids does not qualify for the exclusion. So you have to be very careful with limited liability companies. There are some ways to use the limited liability company to avoid potential future reassessment. It's very complicated, and that would be something that we talk about a little bit offline. So we can continue again to seek some guidance from the BOE here. Is, what if my father transfers less than 100% of the home to me? Will the portion that I receive qualify for the exclusion? Yes. So you can do partial transfers. You can do partial transfer, and then you could do a later transfer, and then the accumulation, if it's parent to child and it meets the $1 million test, you can do that. But be careful with partial transfers that do not qualify for the parent-child exclusion. So they say you can do fractional partial transfers, but if you do 75% to child, and then you do 25% to cousin, you're going to have a reassessment of the 25%, because that one doesn't qualify. So you can do, if one wanted to add a child onto title temporarily, or usually temporarily, but partially, they're added partially, and then they're going to do the rest later. One can do that. But if you split it between people who don't qualify, it's going to be an issue. So we'll skip some of this valuation things here. Generally, it's the fair market value, and they show you how to do that. So that's that. And then death and changes of ownership, all of that. No major issue there. And then claims, you generally need to do it within 3 years of the transfer, or prior to a transfer to a third party, you have to file a claim for the reassessment. So that's basically, so Prop 19, I know that's a lot of information to give you, but what the basics would be is this. I'll give you a quick takeaway for this. I'm going to share a different slide here. I'll give you a quick takeaway of this for what to remember with the Prop 19. The first part, the good part of Prop 19, over 55, so you have to be over 55, can be one spouse or the other. They both don't have to be over 55, has to be over 55. And really the key thing to think about is just for the fair market value when I sell it, if whatever that fair market value is when I sell it, if whatever I purchase is less than that amount, I keep my old basis. Whatever I'm paying at the time before I move, I continue doing that. If it's over the amount that I'm over, so the amount that I'm over in terms of fair market value of my current property, that gets added onto what I was paying as property tax, and my property taxes go up somewhat, but not all the way to the full fair market value of the new property. That's the shorthand, easy way to understand it. There's a lot more complexity, needless to say, as we saw, pages and pages of rules, but that's the shorthand to understand it. On the second part of Prop 19, the kind of bad part, the not so good, the key thing is only applies to the primary residence. All rentals are going to get reassessed unless you do some sophisticated planning with some LLCs, and there's some complicated things of why that might be good, why that might not be good. Usually, if you're doing the complicated planning with LLCs, you have to trigger a reassessment now. So for recently acquired properties, it's probably okay. For properties you acquired a long time ago, maybe not so okay. It may not be worth triggering the new assessment, new assessment on the property tax. So thinking it through, primary residence has to go from parent to child. All children don't have to live there together. It can be just one, but they do have to live there. If one of them's not, if they are not going to live there, then it's going to cause a reassessment. I've seen a lot of people thinking through this, sometimes in their estate planning, their trust, especially if they have multiple children, saying, well, we actually maybe want to keep this property in the family. We don't want it to be reassessed. We probably don't have, more than $1 million, of gain here. And some people are adding provisions into their revocable living trust to say, well, if the child is willing to live there, they can live there and they can enjoy the house, or another child who wants to live there can enjoy it. But they try to create terms and provisions in their revocable living trust that causes preference and urges the beneficiaries to live there if they're able to, and then if they don't, they sort of all have to decide to agree, to sell it. They try to give priority to if anybody wants to move in to keep the house, because again, if anybody initially moves in and then they move out, unless someone new who's one of the children moves into the house, it's going to cause a reassessment. So you have to watch that. So that's the basics of that is primary residence, $1 million. So you take the factor base year assessment, add $1 million to it. If the fair market value at the date of transfer is more than that, the amount that's over, you add to the initial assessment and it goes up. Very similar in a way to calculating the first part. So that is the ins and outs of Prop 19. And I know it's a lot. I think, this is even for my law school students, I think they probably say, whoosh, that was one of the harder classes. But what I wanted to arm you with is, of course, you saw my contact information, and I wanted to show you that there is a place to turn. In addition to me, the BOE is starting to give you some information on this. So you have places to go take a look where you say, maybe I should think it through before I start talking to Mike. I'll go take a look at the BOE website, kind of understand what's going on, probably read the guidance and say, wow, that's confusing, or that doesn't look like my situation. I need to talk to Mike. But it's complicated, but here's the first place to look. And then, of course, I'm always happy to help and work with you to make things better for you. So I'll turn it over to you all for some questions, and I'm happy to hear what questions there may be. I think there may be more than a few.
Thank you so much, Michael. So we have gathered some questions from streaming on YouTube, Facebook, WeChat, and 一直播. So before we get to the Q&A, Michael, if you don't mind, unshare for a moment. I wanted to just give a very quick preview of our next 10 seminar. I hope Larry is online. I didn't see him, but he was going to be here. Larry, if you're here, please speak up. So 3 weeks from now, on Tuesday, April 20th, we'll be discussing property inspections. Since non-contingent offers are so popular now, my team and I spend a lot of time helping buyers and sellers understand the results of a property inspection. So I have invited Larry Tringali, the founder of Property Inspection Services, to enlighten us and give answers to frequently asked questions. So Larry, are you online? If you are not, then we'll just look forward to having you on April 20th. I don't hear Larry. So anyhow, be sure to join us on April 20th at our usual time, 5:20 to 6:30. So let's go to our Q&A session. So there's a question for you, Michael. If I sell the current home, buy another property, but don't move there, instead I move to a rental property so I can rebuild or remodel that property. Then I move into that rebuilt home within 2 years of the sale of the current home. Will Prop 19 apply?
Yes, generally, providing you meet that 2-year rule, it should apply. In addition, if you're doing the new construction, in some circumstances, if you file and prepare the claim form and outline on the claim form that you say it's undergoing a remodel or renovation, I can't live there, but I will move there and claim the perhaps not claim the homeowner's exemption yet, but give them some indication of it, and you do actually move there within 2 years, you'll generally be within the rule. So generally, that's the key thing that we were seeing with 2 years. That will be the thing to keep an eye on with the timing.
Okay, great. We have some technical issues. I think Larry is online. So I have my technical person to help me unmute Larry while we'll continue with the Q&A. So there's so Michael, you mentioned about if the replacement property is equal or less than the value of the sale, then you keep the property tax base, which is the same as what we used to have, correct? For the people who are over 55 years old.
Well, kind of. It's the same idea, but now the old system, we only could do it with 10 counties. So we were very limited in where we could go. So this is one of the good things that's really been a benefit. Classically, and like I mentioned at our top of the hour, my parents lived in a county that was not included in one of the 10. So if they wanted to sell that property, it didn't work under the old system. They would have gotten reassessed, and it wouldn't have been so good for them. So the new Prop 19 is good in that all the counties, it's all the same. You can go wherever you want, whatever county you're from, whatever county you want to go to in California, you can do this. So that's good. What you just have to do is pay attention to value. And this is kind of the key thing for persons over 55, senior Californians, that they say, I'm going to kind of downsize in the sense that my property, the fair market value is high. I'm going to go to a little bit maybe lower value property. Key for a lot of older Americans. I'm going to sell my property, extract some of that equity, and then I'm going to buy a place that's a little bit smaller for me. You can keep the property tax assessment. Really top strategy that I'm seeing for a lot of people on here is that people try to basically calculate and game this, is that they say, okay, I'm going to sell my property. I'm going to extract no more. Let's say I'm a husband and wife married couple, or I'm a couple and we're married. I'm going to use the Section 121 exemption from the Internal Revenue Code, the $500,000 capital gains exemption. I'm going to take $500,000 of gain from there, and then we try to dial that in so that I can unlock that $500,000 gain, and then purchase a new property that is slightly less, and try to do a transfer where I have no more than have no capital gains taxes. I can keep my own property tax basis. So again, if you have a property where it's a husband and wife and you have less than $500,000 worth of gain, you have a pretty attractive potential that you could sell the old property, have no capital gains tax issue, and then you could move into the new property and You could keep your old property tax assessment, providing the value was less, and you could have that cash. So I see a lot of people, older persons, doing things and starting to think through that kind of strategy. If you have more than $500,000 worth of gain, you'll have some capital gains tax on the home, which you'd have to think about. And then depending on the value of the second property, you can, if it's lower, keep the old basis.
Got it. Sorry for a little interruption. We have unmuted Larry. So Larry, if you can come online, just give us a 30-second preview. That'd be great.
Yes, I was unmute me. But you know,
Wait, we don't even see you. There's no.
Yeah, it was
reading.
only me and my dog that paid attention to that. So
Okay.
the whole goal of being an excellent agent is, and the more experience you get, the better you get at this, is you're trying to anticipate what are the problems that the client's going to have. You realize them, you prepare them for those problems, you mention them, and then you give them the answer right then. And the more you do that, the better you look, the more referrals you get. But now, having been on both sides of the fence, been an agent for a long time, now I got this inspection company. I was never aware of all the calls that people were making to who knows where. And now they're making them to me because I have the inspection company. They move into the house. They say, what about? I've got a whole list of things that is very typical of people who move in, especially first-time home buyers, they're not aware of. So they call and ask me because they think for some reason I own the inspection company. I must know everything. So they call. So that's what it's going to be about. I'm going to give you a list of like the top 5 or 8 questions that new homeowners call and ask me. That way you're going to know that. You're going to look so wizardly because you're going to tell them about these problems. They go, oh, gee, I never thought about that. Yeah, that's why they're using you, the ultimate professional, because you did think about that and you're answering that problem for them before they even come up with it. There, that's a pretty good hook, huh? I hope to see you whenever it is. I don't know when we're scheduled, but when we're scheduled, it'll be worth showing up to listen. Okay, I'm done. You can mute me again now if you want.
Thank you so much, Larry. I am so sorry about that, Michael, for the interruption. I do have
I'm interested. I'll join you next week or so.
That's a good thing.
I'll be there.
Let's do that. Yeah, April 20th. Okay.
Good.
That's great. So going back to the question, Michael, assume the assessed value was 500,000. So if they sell the home for 1 million, buy another replacement for 1.5 million. So just make sure I have the right understanding. So the property tax base will be the 500,000 plus the difference between the 1 million and 1.5. So it's going to be $1 million, right? That's the property tax base.
Exactly. That's going to get added in there. So they'll have the old one, but because they purchased something more expensive, the difference you have to add. And it's the same thing if you, the new property is 1.5 million, 2 million, 2.5. As the difference increases, the tax increases. So it's a sliding scale.
Oh, I see. Okay, makes sense. That's great. And then the next question is, for the Proposition 19 provisions for 55 years or older, do both spouses need to be over 55 or just one of the two?
Luckily, just one of the two.
Okay.
So that one's been good. Even in the initial rollout of Prop 19, they were pretty clear on that. So one of the two is fine, and that's how the claim exemption form looks. So we'll be good with one of the two.
Okay. And what does this law mean for someone below 55 and no kids currently or younger kids? How might we do some planning on it?
And this is actually a little bit of a challenge. And I think what we're thinking about on this one is for the second part of Prop 19. If you're under 55 and you're thinking, I'm not really up there, so I'm not looking at that. Really, the thing is you're looking at your general estate planning and you're looking at the second part, thinking, well, how do I preserve my property tax basis for my kids? And really, what we're thinking about is designing in your revocable living trust structures. If we say, well, how many children do you have? Do we want to preference or give some priority for living in the property, where we encourage people or give, generally what we do is we give the trustee power to encourage children to live in and stay in the property so that you can keep the property tax assessment. We've done things like that. And then That's generally, again, for the primary residence. So with the primary residence, you're really thinking about value and thinking about the children and family structure you have, of what you can do. The second thing, though, what you can start to explore is if you say, well, okay, that's all well and good. I understand that for primary residence. What about things like my rentals? What about my rental properties? Because gosh, if these all get reassessed, the cash flow is going to be very, very different. Then we have to start talking about, do we use LLCs and use a kind of clever transferring system of the LLCs? And depending on the values of where they are, do we seek to try to trigger reassessments now? So for example, if one had, let's say, a relatively recently acquired rental property, and they had acquired this rental property, and they said, we probably should have done it in an LLC, but we didn't. We just did it husband and wife. Maybe what we want to do, because the value from when we bought it and the value now is relatively similar, maybe we want to put it in an LLC. Maybe we want to trigger a reassessment and actually cause that LLC to get reassessed. There's a special rule for LLCs called the original owner rule. We have to get around that. There's a lot of these crazy rules. But if we do that and we have 2 children, we potentially, using the LLC and going through this fancy series of transactions, potentially could prevent the property tax reassessment on this perpetually. There's a fancy trick about this, and it's, if you're curious about it or just for your own fun, it's often called the Ocean Avenue case. And it's basically how Michael Dell bought the Santa Monica Fremont Hotel and had no property tax reassessment. So it's basically actually part of it. He sold it, and the system is there was no property tax reassessment, and it was because they used an LLC and they had fractional ownership, and they kept the fractional ownership the same on one end and the same on the other end. So there are some ways, even after Prop 19, that you can maintain your property tax assessment for rentals for your children. It's a little complicated. There's a lot to take a look at. It's not really good for all properties, but for some of them, it can be really, really valuable. And that classic one, Ocean Avenue and Michael Dell, he saved millions and millions and millions of dollars every year doing it. So for the right property and the right set of facts, it can work really well.
Great. There's 2 questions here. If I simply transfer my personal residence to my only son, will he return the original tax basis, and will I need to pay for gift taxes? Same question for the number 2, but if I die, my son will inherit my house, but will he return the original tax basis?
Yes. So let's talk about the first one and say, I give the property to my son during my lifetime. First thing that we have to take a look at is, let's say the Prop 19, the California state taxes. And what we would look at is we'd say, what is the fair market value on the date of transfer versus your current base assessment. So if your current base assessment, let's say, is $300,000 and the fair market value of the property is $1 million, you could transfer it now. And you could give it to one son and say, okay, because the whole fair market value is less than $1 million, when we add on 300, 1.3, we're under. I'm going to do a transfer. I'm going to change the deed from Michael Lee, dad, grants to Ewan Lee, son, and I'm going to record the deed. I'm going to transfer it. So that will work, providing we claim the exemption. That will keep the old property tax, providing, again, my son claims it, and that's effective. But the key is, our first question is value. What are some problems with this? Example, my example that I gave, if I gave it to my son is 3 years old. That would be a disaster to give him real property because he cannot sign any loan documents. He can't sign to sell. If I grant it to him and then I need to sell it, I'm going to have to file a guardianship of his estate proceeding in court. So anything that I saved in the property taxes, I would probably have to pay in the guardianship proceeding to the lawyers because transfers to minors cause a lot of problems. So there's one thing. You have to think about the age of the kids. You also have to think about, okay, he's over 18. he's 19. He's in college. I say, okay, tell me about him. He's 19. I say, oh, he's a good kid. He's got a Corvette. He drives real fast, in the Corvette, but he's a good kid. I say, you gave your primary residence to a 19-year-old with a Corvette. How much do you have in auto insurance? He says, oh, he's got a 100, 300 policy. He gets into an accident. He's going to be sued. He's going to be sued to death. That was not a clever transfer because you potentially expose the property to a lot of risk with the child. What if you have a falling out? You transfer the child to the child, there's a problem. So that's, a couple of examples of when you do the parent-to-child transfer. You have to think it through from, there's a tax angle, but then you have to think through it from a kind of liability family angle as well. Tax angle again, what about gift tax? Generally, you will not have an issue with gift tax for, let's say, same example, I gifted the property, the fair market value was $1 million. I bought it for, let's say, 300. I've given a gift of $700,000. This year, the gift tax exemption is $11,700,000. No problem. No gift tax is due. Even if I do this after 2025, the law is today, it will be $5 million after 2025, starting in 2026, there'd be no gift tax due. But you are supposed to file a gift tax return. So you do technically have to file a return and tell the IRS that you gave the gift. But let's say, and I had a lot of families do this, is they say, it's a really nice property. I'm in my, late 50s, late 60s. We've had about, it's kind of this example, we've had $700, $800, $1,000 worth of gain on this property. If we keep holding this another 20 years, the rest of my lifetime, it probably will be over. It probably will cause, a reassessment there. And, let's say my children, the young family, they can go live in it. They can go live in it, or they're going to go live in it with me. They can claim the homeowner's exemption. Maybe it's an appropriate transfer. That's the second thing that we have to remember. They have to live there. Again, if you say, well, I'm going to add my son or I'm going to add my daughter, where do they live? If they say, oh, no, they have their own house. They live in Milpitas. They've got their own house. I just want to, keep the property tax low for them. It's not going to qualify because they have to live there. Flip side, and to the second question, is what happens if I transfer it after I pass away via my estate plan. Hopefully, it was through a revocable living trust. It was through your estate plan. You'll avoid probate. That's good. And then in that situation, you really just have to look at the value. If the factored base year assessment, the assessment in the year of death, you add that, plus $1 million together, you get a number. You compare that number to the fair market value that's going to go to the kids. If it's equal to or less, there's no additional tax. If it is over, it's going to increase the factored base year at that time. So it's a calculation.
Very complicated, but thank you for the explanation.
That's the thing. It is very complicated. And that's the one thing actually that I do urge everybody, and I expect to be seeing in the office over the next few months, is even before February 16th, there were a lot of transfers that people were transferring property all over the place to try to beat the February 16th deadline. The same thing now. I strongly advise everyone, before transferring anything, please make an appointment and talk to us, because I made a joke, and this is a kind of a good way to end our lecture. I made a joke that the Prop 19 is a lot like this game that my son has called Gears, Gears, Gears. And basically it's this children's game, and you have a board and you can stick these gears onto it, and you turn this gear, the orange gear, and the green gear turns the other way. And then the green gear turns the purple gear another way. And the purple gear turns the red gear the other way. And you turn this one thing, and all of these other things, all these other gears move. That's Prop 19, that's property transfers. So when you say, I'm just gonna give it to my son, that turning the gear changes all of the other gears. So you have to be very careful, because you may say, oh, I've saved a bundle in, let's say property tax. I've saved a lot of money for my property tax for my transfer. And they say, but wait, let's say you did this again, I have a lot of people, were thinking about this before February 16th. Wait, your son doesn't live there, right? No, he doesn't. He lives out of state. I saved him the property tax. I say, but wait, didn't you have quite a bit of like $500,000 of, potential capital gain? Yeah. I transferred it. It's like, so you're telling me that you saved the property tax, but now if he sells it, he's going to get stuck with the capital gains tax on the 500,000. And you said he's a doctor in New York, so he's at the highest marginal rate. Oh, I didn't think of that. I just thought about Prop 19. It's like gears. You turn the one thing, but then all of the other things turned. So that's what we try to work with everybody, is to say, okay, if we turn one thing, do we like the results for all of the others? Because sometimes we don't. Sometimes those other things that turn are really, really bad. So that's what we try to explore, because it is complicated, and we try to make it simple. Tonight, I feel like we may not have made it so simple, but at least we can know some basics, and at least we know it's complicated, and we need to take a look out for it.
That's a very good statement. That's why we need you to be here, Michael. So if
Oh,
you don't mind staying for another 10 minutes, I'm going to try to condense the questions. May have another 5 questions here, maybe 1 minute per question.
Yes.
The multiple people asking about if they can buy first and sell later. Does that Prop 19 apply if you buy first instead of selling first?
As long as you do it within 2 years, you generally can do that.
2 years, okay. And what if they sell? What if I sell my current property, then move to my rental property? So this rental property will become to my primary home. Does that Proposition 19 also apply?
Yes. So you could do that. So you could, as long as you sold the first one, and then you move to the second one, and you claim the homestead exemption there, and you file the application. Yes, you generally could do that.
Okay. What if at the first time transfer, I purchased a property higher than my house value? In the second transfer, I purchased a house that's lower than my previous primary home value. Can I keep the original property tax base, or have to add on from the first transfer?
You'll have to generally use from the first. There are a number of, as we saw, and actually if we go through some of that, we won't go through it now, but just looking at the BOE explanations there, and I didn't show you some. Can you believe some are more complicated than the ones that I showed you? They are trying to prevent too much gamesmanship with some things like that. So one has to be careful. If one's going to do multiple transactions like that, come chat with me, because one has to be cautious, because they're trying to prevent too much moving around.
So you don't have to, it's not just one time move. You can take the lower tax rate if you move a second time too, right?
Oh yes. So if I had a primary residence and I moved to the next property, and then that property didn't work out for me, and then I moved again, I can definitely do that.
Okay.
So that's no problem. But if we're acquiring in different orders and putting the homestead exemption on different things in a kind of strategic way, we have to be a little bit cautious. If we're just doing property 1, I live there, they go to property 2, I didn't really like it, I moved to property 3, it was okay, then I moved again. As long as it's no more than 3, we're okay if they're in series, but we have to be careful with sort of back and forth moving and things like that.
Okay. Does a non-resident alien have the $15,000 annual gift tax exclusion?
Yes.
And also a non-resident alien over 55 years old or older purchased a house in California a few years ago, but never living that house and never rented out. Does that house qualify as the primary residence, or second home qualify for Prop 19 property tax base transfer when they sell the house, then buy another one?
Yes, this is this one, this question, this person I strongly recommend come chat with me. Non-resident alien transfers can be fatal. So to the first question, is the $15,000 per year exemption? Yes, non-resident aliens have $15,000 per year of U.S. citizen property that they can gift out per grantor, per grantee. Regarding the primary residence, on that one, that's a little bit complicated. Because they potentially have their foreign residence and then their U.S. residence. And that's going to be basically something with facts and circumstances to determine which one is mainly theirs. Generally, what I would seek to do to guide that client is to say, you need to start creating a burden of proof file where you say, this property that I had was for U.S. purposes my residence. That was generally where I lived. That's where my mail went. Maybe if I filed any tax return or I filed anything, it went to there. All of maybe my anything for my visa or anything, it went there. We need to create a burden of proof file for this. And actually, there's a kind of an interesting case that came about. This is just to give an example of how picky the Franchise Tax Board and the BOE is about this. This was for whether California state taxes apply to someone if they move out of state. So this was for someone who decides to move over to Las Vegas or move over to the Nevada side of Tahoe and says, oh, perfect, I've gotten away from the California state income tax. I'm on the Nevada side of Tahoe. I'm so smart. Well, the FTB said, we're smart too. This was a very high net worth individual. And the FTB basically subpoenaed all of their credit card records. And this case is becoming, they're calling it the Starbucks case. And basically they just highlighted the location of all of the Starbucks that they went to and said, looking at the calendar and the Starbuckses where you're buying coffee, they all look like California Starbuckses. It looks like you're on our side of the border. You're taxed under our system. So the reason I put that example is the FTB BOE uses this system of, where are you? So for someone who's a non-resident alien, you'll need to create some facts to show that that was a primary residence. You also have to be aware that if you transfer it by gift or by death, unless the property is worth less than $60,000, your estate tax is charged whatever the fair market value is, minus $60,000, hit with a 40% rate. So for someone who's thinking that I'm a non-resident alien, I'll just transfer it to my son or daughter by gift or through inheritance, there is a massive, massive tax there for you. So you really need to actually talk to us because there are many special ways that you have to prepare to reduce or avoid that tax. Holding it in your own name and saying, even with a revocable living trust, I'll have it be inherited by my kids. The property tax is not your problem. It's the federal estate tax. That's going to be the killer.
Michael, I think we probably need to give another speech on trust and also estate planning because I have a bunch of questions on those. I'm going to read to you and you see what you can answer. Do you want me? I'm going to read a bunch of them to you.
Great.
Number one, if family trust says one spouse dies, then 50% of rental property goes to the kids. Does that mean the 50% will be reassessed? Then number two, what is the best way to save capital gain tax when we're selling houses for a non-resident alien, not leaving the house, but not renting out either, in the case we mentioned earlier? Any differences of gift tax, or if gift the home to a relative in the US during his lifetime or after death? So any difference from that? And then to pass the rental property to the next generation, and it is under revocable trust, what is a good way to save tax and property tax?
Okay. Yes. So both of the questions about the revocable living trust, if one passes away, the first question is, let's say after the death of the first spouse, half of the real property goes to the children. We have to be careful with this provision because if it's basically saying, well, after your wife passes or husband passes, instead of that going to the spouse, it goes to the kids, that's going to cause a requirement that the kids live there. It doesn't have to be all of them, but it's going to have to be one of them. And one of the children, unless someone actually is living with the parents, that's going to be a problem. It probably would be better if one was going to want to do a provision like this, is that because transfers between spouses in the revocable trust do not trigger reassessment, you structure your revocable living trust. Sometimes if you want to protect one spouse's share and say, I don't really want to give it to my spouse 100%. Basically, what one would do is sometimes we use what's called a qualified terminable interest provision. They call it a Q-tip. My share will lock. My spouse maybe only has the right to some income from it. They don't have the right to get to the principal. And then after my spouse passes away, the whole thing drops down to the kids. That's going to be a little bit better If you have a problem with the kids not living there, that's going to be, your first task. And then the second thing is going to be a value issue. Is there greater than $1 million on the primary residence? If the concern is regarding rentals, rental properties, that's much more complicated. We have to think about LLCs or doing something like that, because the old Prop 58, the rental system, that's just totally gone. So those would all automatically be reassessed unless we do something. Thinking about a non-resident alien, pivoting over to that, for the non-resident alien, if they are selling a property, generally for any non-resident alien, they will be subject to the FERPTA rules. If you've ever encountered these, anybody who works in title and escrow has dealt with FERPTA and realized that's such a mess. Basically, under FERPTA, there will be a 30% withholding of the taxes. And then the non-resident alien has to file a tax refund and get the 30% refunded to them. So there's that 30% amount. That's, as we can see, higher than the top capital gains rate of 20% plus 3.8, so 23.8. Be very cautious. There was, in the question, there was a thought of, well, what if I gift it to a US person? Be careful. I had this exact case once, is where someone, non-resident alien, gifted it to her F1 daughter, the student daughter. This was San Mateo County, gifted it. And San Mateo County, the San Mateo County recorder sent that to the IRS, and the IRS said, oh, okay, the property was $1.7 million at the time of that deed. So you gave a gift of $1,640,000. We apply a 40% rate to that. You owe us $900,000. Please pay. That's a problem. You have to be very careful. Or anyone who is, a professional in, ensuring, of when the daughter, the title was taken in the, they get really upset and they try to blame other professionals. So it's always good if you're a professional, you say, oh, you know what, you're a non-resident alien, this is a little complicated, go talk to Mike, he'll guide you through all the tax stuff, and I'll do what I'm good at, which is, whatever else there is. So that's can be helpful and safe.
Thank you so much. I hope Professor Michael Lee do not need to run back to the classroom to finish teaching your class today.
We'll have a little bit, I'm just assigning a little bit of homework today. So
oh my gosh. So everyone has been allowed to unmute themselves so that everyone can say thank you to our guest, Michael Lee. And also, a lot of people asking for your contact information. So Michael, I will forward your information to you. Yeah, thank you.
Cheers all. Thank you so much.
Thank you.
Thank you.
I love gears.
Yes.
Thank you very much. Wonderful information.
Thank you. So afterwards, if you want to chat with each other or with me, please feel free to stay. We can talk about my newest listings or anything you want, or ask Michael Lee for any questions. If you are about to leave, I will see everyone on April 20th. So good night, and then anyone feel free to stay and then ask questions.
Thank you so much.
Clapping. Thank you.
Thanks.
Thank you. So Michael, thank you so much. You have been always